from BSE Limited, and Mr. Naveen Mathur, Director, Commodities and Currencies, Anand Rathi Group. We are apparently also joined by Mr. Rajiv Agarwal, our co-chair for the Capital Market and the Commodity Market for PHD Chamber of Commerce and Industry. So, a very good evening once again. And as the temperature continues to dip, but the curve for the gold bonds continues to rise, I think a good time to discuss it. And I can see a broad smile on Mr. Vijay Bhushan's face when I talk about the rise in the gold markets and the gold sovereign gold market. So I would like to kickstart the conversation today with a presidential address from our president, Shri Sanjay Agarwal. Sir, over to you for guiding us for this webinar.
Good evening, everyone. On behalf of the PHD Chamber of Commerce and Industry, I would like to welcome our panelists of the session, Mr. Sameer Patil, Chief Business Officer, BSE Limited, Mr. Naveen Mathur, Director, Commodities and Currencies, Anand Rathi Group, Mr. Ranjit Singh, Deputy General Manager, Products and Business Development, BSE Limited, and Mr. Madhav Bharat Bhushan, Co-founder and Vice President, Indian Youth Economic Association. I would also like to welcome Capital Market and Commodity Market Chair, Mr. Vijay Bhushan, and Co-Chair, Mr. Rajiv Agarwal, as also Mr. Vivek Sehgal, Assistant Secretary General of the PHD Chamber, to this program. I would like to begin by introducing the Chamber briefly to you all. The PHD Chamber of Commerce and Industry has been working as a catalyst for the promotion of industry and trade and entrepreneurship for the last 116 years. We are a forward-looking, proactive and dynamic pan-India apex organization. As a partner in progress with industry and government, the PHD Chamber, with a special focus on MSMEs, works at the grassroots level with strong national and international linkages for propelling progress, harmony, and integrated development of the Indian economy. The PHD Chamber is one of the premier chambers in India to have been accredited with the diamond grade NABET QCI at national and international level. The PHD Chamber reaches out to more than 150,000 companies with a total focus on development of small and medium businesses. Coming to the subject for the day, Indians have always had a great reverence for gold, which is even beyond its market value. Yet, over the years, the market has witnessed a considerable decline in the demand for physical gold. Sovereign gold bonds are one such alternative offered by the Government of India and RBI to own gold without the inherent risk of physically holding it or bearing the making charges. The introduction of sovereign gold bonds was announced in the Union Budget 2015-16, and the scheme was formally launched by the Honorable Prime Minister of India, along with two other gold schemes, the Gold Coin and Gold Monetization Scheme, on 5th November 2015. The scheme was launched on the basis of KUB Rao Committee report of 2013, which observed that India has a large appetite for gold and the economy needs to moderate the demand for gold imports so as to bring down the current account deficit to a more sustainable level. The report suggested that there is a need to consider introducing new gold-backed financial products to reduce the demand for physical gold. The Government of India has notified Sovereign Gold Bond Scheme 2020 at a time when the world was going through COVID-19 pandemic, resulting in surging of gold prices and money again chasing safe havens. Through this scheme, the government is not selling its gold reserve, as the same will reduce its capacity to infuse money into the system. Rather, it has chosen a better method by issuing a piece of paper stating liability of the government to pay in future based on future gold prices, carrying an interest rate of near 2.5% per annum, which is less than the interest rate earned by us even on our saving account. A total of rupees 9,652 crores approximately, and in quantity terms roughly 31 tons has been raised through the scheme, over 37 tranches since its inception in November 15. The investment in sovereign gold bonds is attractive for those investors looking for a long-term view of gold, as it provides a window of exit after 5 years, despite having a full tenure of 8 years. For those investors holding the bond till maturity, there is no tax on capital gains. Also, there is no tax deducted at source on interest paid. Although the sovereign gold bonds are listed on stock exchanges, there is no assurance that they will trade near the fair value. Past trading experiences show listed sovereign gold bonds have seen an increase in average volumes recorded over a period of time. These bonds mostly trade at 2 to 7% discount to the prevailing spot price of gold. It is believed that in 2021, gold will remain in focus for investors. The efficacy of vaccine, proper implementation of vaccination process in the developing countries, low interest rate regime, and the global central bank's insistence on liquidity will guide the gold prices in 2021. I must say, gold is an important asset in the portfolio at all times, and to keep an allocation of 5 to 10% of portfolio in gold is a good strategy. What I am really surprised at is the discount levels of 6 to 7% over the gold price happening, which is probably should be a good buying opportunity by itself, to my mind. The feeling is, the recommendations from our experts, of course, is that investors should not panic and remove their investment from gold, even if there are ups and downs in the prices of gold. That in the long term, it is a great real asset to hold in an investor's portfolio, and it will not only provide portfolio diversification, but also a hedge against inflation. Today, we have got very eminent panelists to discuss about the benefits or challenges being posed by these bonds. So, on behalf of PHDCCI, I again welcome you all, ladies and gentlemen, and really look forward to this active, to some great discussions happening in this webinar, and some great conclusions and advice emerging from it all, with the sort of expert panel that we have. Thank you so much. Thank you.
Thank you, President, for those wonderful remarks, and a warm welcome to all our panelists. I'm sure today's deliberations will not only make this concept a lot more clear and in the minds of people, but your guidance on the subject matter will probably be taken forward by our esteemed panelists today. With that, I'd like to now request our Chair of the Capital Markets and the Commodity Markets Committee of PhD Chamber of Commerce and Industry, Mr. Vijay Bhushan, to kindly give his remarks. Over to you.
Thank you, Vivek ji. Good evening. I would like to welcome all delegates to this webinar on sovereign gold bonds, organized with the partnership of the Bombay Stock Exchange. First of all, yesterday has been a momentous day when the BSE Sensex crossed 50,000. And with BSE also being our sponsors and our partners for this event, first of all, I would like to thank Mr. Samir Patil is here. I would like to thank you, Samir ji, and also my thanks to Ashish Bhai Chauhan, the MD of BSE, for what a fabulous work you have been doing. For 42 years, you've been running this, the Sensex, and you've done a wonderful job. And it's today it's a matter of pride for us that there is a benchmark which talks about about India and has been maintained over the years. And you've also made the modifications that were necessary so that it reflects to a large extent the market capitalization. So first of all, my appreciation.
Absolutely, I think we all deserve to clap our chair. Mr. Vijay Bhushan is absolutely right. This is a huge benchmark, and it is as much a testimony to the stability and efficiency of BSE as it is to the strength of our economy. Please,
Right. So now coming to the topic, first of all, a warm welcome to all our panelists. Thank you, Sanjay ji. I know with PhD doing about, close to about 70, 80 seminars a month, that Sanjay ji has taken out time to be with us here today. I am really grateful to you for that. Sameer ji also had some board meetings coming up today, so I'm thankful to you for sparing your time to be with us here. Of course, Mr. Ranjit Singh will be giving us, the full details. Also thankful to Naveen ji, who straight away said yes when I said that, I need your help to be able to, talk about both the fundamental and technical, parts about what does he think of gold as an investment. And of course, to Madhav, who's done a lot of groundwork on this and some things which I didn't even know. I've come to know because of the fact that we've gone through the fine print. And of course, the team at PhD for making that possible. I have the help of Mr. Rajiv Agarwal, the co-chair, and who has been always very helpful. And of course, he understands perhaps the commodity market much, much better than I do. So now coming to the gold bonds, as you know, gold is one of the preferred investments. And it has, over time, we don't have to tell people that, you can invest in gold, because people have invested in gold. And of course, maybe it was gold jewelry, because there was a time when primary gold was not permitted as an investment. So I think people understand gold, and I think it was a very, the step of the government to come up with, I would call this paper gold, the sovereign gold bonds. In November 2015, the first tranche was issued. And then, as already mentioned, 37 tranches have been there. In this year, starting from April, we have had a tranche every month. And the next tranche is on budget day, on 1st of February. So, there are people which are, the tranches have been there. And of course, the government was issuing these bonds so that people do not go for physical gold. As you know, the gold imports happen to be one of the largest imports which we were doing. With an adverse balance of trade, the government thought that, something for people who want to invest, why not give them another avenue, which is paper gold. And as most of the people, which will be explained, this has been an excellent instrument, perhaps not so much well publicized. So again, my compliments to BSC for having taken this up and bringing this in focus. So, because it's important that, today when we buy sovereign gold bonds, actually we are in a way helping to bring down the possible imports which are going to be there. As well as, of course, the government also wanted that, there was a feeling that all black money goes into gold. Because, they say that when you buy gold, you have to pay in cash. So they wanted to get away from this kind of a concept, as well as to also make it possible that all money that used to go into gold, that could also be diverted towards financial saving, personal savings of people. And the sovereign gold bonds also help the government today in reducing the cost of borrowing, which is about 7 to 8% per annum. On gold bonds, they pay 2.5%. It is an annual saving to the government. And the difference is used to cover the appreciation of gold, so that the prices that are paid to the people at the time of redemption. So it is beneficial to the government. As far as investment in gold is concerned, I think, first of all, I would say that don't consider investment in jewelry as investment in gold. Because investment in jewelry, there are making charges, and when you go to sell that, there is a discount of 10% plus. So I think that should not be considered as an investment. Whatever you have jewelry which is there in the family, you consider it as something which is an asset, but that is not a substitute for the sovereign gold bond. So that should not be considered per se as an investment into gold. So why gold? I think it is a good diversification. As we say, you have to allocate your assets. There are a lot of people who only go into real estate, and they were very unhappy in the past few years, because ultimately what is important is being able to diversify your investment. And because tranches are coming every virtually every month. And as you know, between November and now, there have been 37 tranches. So one can even consider doing a systematic investment in a tranche of gold every month, so that those who are under-invested in gold or who have fresh monies where some portion they can allocate to gold, they can make this investment here, or they would need to accumulate gold for weddings, because at that time you can sell, or other auspicious occasions, you could do the same. Now, to just give you an idea of, you see, as I already mentioned, November 2015 was the first tranche. And going by the last tranche issued in January, now, there is an appreciation of 93%. So there is almost, it has doubled. And as already mentioned, after 5 years, government offers a buyback at the prevailing price of gold. So you can book your profits there. And mind you, the entire profits would be tax exempt, because if you get your redemption from the government. So actually, this, in my view, it's a substitute for tax-free bonds. There is a great demand for tax-free bonds, and the yield on tax-free bonds is much lower. It is now in the region of below 5%. It is between 4.75 to 5%. And here, even if you go by of course, the last the tranches of the compound annual growth rate in case of sovereign gold bonds has been over the past few years, from the first series till the last series in January 2021, it's been over 14%, the compound annual growth rate. And if you take a 25-year period of gold, it is close to 10%, just below 10%. So imagine you are having a tax-free bond, or giving you a yield of 10%. So I think people haven't thought of it in that way, but they should seriously look at it, because it gives you that stability and also tax exemption, unless of course the government decides that we should take it away in this budget. And from an investor allocation point of view, we believe that in an aggressive portfolio, there could be, with equity and debt, there could still be a 5% allocation should be made for gold. And for a conservative investor, I think the allocation could be higher at 10%. So I think if you look at your portfolio and exclude jewelry, you will note that you are underinvested in gold. Very few people have a 5% investment in gold. So sovereign gold bonds gives you that option. There are some other options which I think Madhav is going to take up. The next tranche of sovereign gold bonds will be launched on budget day, 1st February, and will close on 5th February. So this is the opportunity to start investing in sovereign gold bonds. And of course, now, the other experts can give a better idea on, how the gold bonds, can be a preferred investment for most of you. Thank you.
Thank you so much, Mr. Bhushan. That indeed was quite revealing in terms of what all can be done on the gold front. And I think I really like your point where a lot of jewelry back at home is considered as an investment in gold. And actually, when you go and even change the jewelry or encash it, there's a lot of deductions. And that is the time when you start frowning, oh, was it really an investment? So thank you very much for those inputs. I think youngsters have this knack of, getting into the details and finding some new aspects or dimensions to what the old school of thought has been thinking. And that's what we got to, I think, hear from Mr. Madhav Bharat Bhushan. He's the co-founder and vice president of the Indian Youth Economic Association. And before I invite him to speak, let me read a quick few lines about him. The young, dynamic gentleman on our screens. He's also the vice president of Bharat Bhushan Equity Traders Limited and holds a bachelor's degree in management studies and finance from the University of Delhi, and has done his master's in management studies from Duke University at USA. He did his practical training with the consultancy division of EXL in New York. He is a certified mutual fund distributor, general insurance agent, equity derivatives dealer, and a research analyst, and is focusing generally on broadening the scope of advisory services provided to clients and implementing new age technology and in-house research for equities and alternative investment funds. So over to listening to the young man on our screen, Mr. Madhav Bharat Bhushan. Over to you.
Thank you so much, Vivek, for the full introduction. A very warm and a very good evening to the team leadership at PHD and my fellow panelists. It's truly an honor to be part of such an eminent panel. I'll just share my screen and prepared a small presentation. So today we've had
1 minute. Madhav, I think you're very close to the screen. The voice is too loud. Could you do something to tone down the volume?
Sure. So I've just prepared a small presentation on sovereign gold bonds. I think, as has been mentioned, we've discussed how gold is an important investment, specifically in the Indian context, and how sovereign gold bonds have actually not penetrated the market very well so far, and very few people know the details about these bonds. So I've tried to go into the details of explaining what it actually is. So before doing that, just a small note on why we are talking about gold at this moment. A few of the major reasons are that the equity markets are very volatile and currently trading at all-time high levels. And if you look at the price to earnings ratios, it's been the highest ever from an Indian perspective. Your yields on fixed income products are also very low. So even if you go to buy bonds or fixed deposits, the earnings on those products are at their lowest currently. Gold also adds helps to diversify your portfolio. And whenever you compare gold, you always look at how it compares with inflation, because it has always talked about being a good hedge against inflation. And we've seen that in the 5-year period, where gold has given a return of more than 14%, and inflation has only gone up by about 3.5% in the same period. Lastly, gold is called the safe haven, and it is because it has worldwide acceptability and standardization. So it does not, your investment in gold will not be hampered by the country you live in or political scenarios anywhere. Gold will always hold its value, which is why it's called a safe haven. And talking of safe havens, we go into discussing the safest safe haven that you can get as an Indian investor, which is a sovereign gold bond. So some of the salient features, I'll be just running through the basics of the sovereign gold bond. So these are issued by the RBI on behalf of the Government of India. These bonds specifically are restricted for sale to resident individuals, HUFs, trusts, universities, and charitable institutions. The bonds are in denominations of 1 gram, which means the minimum investment has to be 1 gram of gold, and the maximum limit. This is, mind you, this is an annual limit that is set. So even if you are investing in multiple tranches, in a given financial year, no individual or HUF can buy more than 4 kgs of these sovereign gold bonds, whereas trusts and similar entities can buy up to 20 kgs of gold bonds. The tenure on these bonds are 8 years, but investors do get an option after the 5th year where they can redeem these bonds with the government. The redemption can only happen twice every year from the 5th year onwards, which is the interest payment date of these bonds. You can have a joint holding in the bonds as well. The issue price of the bond is determined on the average closing price of the last 3 working days preceding the week where the bond is open for subscription. You can also avail a discount of 50 rupees per gram if you opt for an online method. So the webinar is sponsored by Bombay Stock Exchange, and if you also apply for these bonds through Bombay Stock Exchange, you'll be applying online, and then you can avail a very good discount of 50 rupees per gram on these bonds. So these bonds are issued, they have a holding certificate. They're also eligible to be held in a demat form, so no physical paper is to be taken care of. The redemption price also, just like the subscription price, will be based on the previous 3 days simple average of the closing price for the 999 purity published by the Bullion and Jewelers Association. So, like I said, the sales channels through which you can buy these bonds is commercial banks, Stock Holding Corporation of India, designated post offices, recognized stock exchanges like the Bombay Stock Exchange and National Stock Exchange, who might then decide to do it either directly or through agents. The interest rate that you earn on these bonds is 2.5% per annum, which will be paid to you semi-annually based on the nominal value at which you buy the bond. These bonds can also be used as collateral, just like physical gold can be used. The loan to value ratio is set by the RBI from time to time, so that is easily available. Now, the tax treatment. This is one of the major things that really makes the sovereign gold bond attractive. So, there are two aspects to this. The first is the actual gain on gold. So, the capital gains on gold, if you redeem the bond with the government, will be exempt from any taxation. However, the interest of 2.5% per annum that you're getting will be taxable. So, this is how the tax treatment will work. In terms of tradability, these bonds are liquid. These bonds are traded on the stock exchange, and in case you want to exit it before the tenure of 8 years or even before 5 years, you can sell them on the stock exchange and liquidate them. Now, going through the basics of the bond, I decided that let's compare it with the traditional other investments that one seeks when they talk about gold. So I've compared sovereign gold bonds with gold ETFs and with physical gold. So firstly, the purity. Like I said, the sovereign gold bond purity is 999 and it is guaranteed by RBI. Similarly, gold ETFs also claim to have to be investing in gold with 99 purity. But whenever you buy physical gold, you can never be sure of the purity because you have to rely on the honesty of the jeweler or retailer from whom you are purchasing gold. So purity is one major factor in favor of paper gold, which is either sovereign gold bonds or even gold ETFs. The making charges. Again, as we are investing in paper gold, there are no making charges in sovereign gold bonds and gold ETFs. However, there are making charges when you buy physical gold, and it will vary substantially depending on the form in which you buy physical gold. It could be bullion, it could be coins, it could be chains, etc. Now, when we talk about liquidity, without a doubt, physical gold is the most liquid form of holding gold because you can go to any retailer and get a value for it immediately. Although gold ETFs and sovereign gold bonds both are traded on the exchange, the volumes are an issue. So anybody holding them in large quantity might have faced certain difficulty in actually liquidating them quickly. So this is, I feel, a problem more because not many people know about these products yet. And as acceptability of sovereign gold bonds increases, I feel the liquidity issue is something that we can easily overcome. Interest rate. So sovereign gold bond is the only gold product which will also give you a return in form of an interest. Although 2.5 is very nominal in interest, it is something. And something is definitely better than nothing. Then we come to holding cost of gold and the risk of holding that gold. Well, like we said, it's paper gold. So there is actually no holding cost or risk when it comes to sovereign gold bonds because they are in your demat account. Similarly, gold ETFs do not have any risk when it comes to holding them, but there is a cost. The annual management fee for managing the gold ETF is payable on ETFs. So that means there is a holding cost. And when it comes to physical gold, there is both a holding cost and risk, wherein you will be storing the gold either at a locker or at your home. So there's a cost involved in managing that gold, and definitely it's more risky than having paper gold, as the chance of theft is always there. Tax treatment, like I said, in sovereign gold bonds, the capital gains tax are exempted on redemption by the government, whereas in gold ETFs and physical gold, it is considered to be long-term after 3 years. So you get the long-term capital gains tax at 20% with indexation benefit. So finally, to wrap things up, total returns on sovereign gold bonds are actually higher than actual returns on gold because you get an additional 2.5% interest as well as a post-tax return is also better because your capital gains are exempt from any taxation. Whereas in gold ETFs, the returns are actually lower than that on actual gold because you are annually paying a management fee on the ETF. And physical gold, again, it's lower because when you resale it to a jeweler or a retailer, they will again charge some margin and they will not give you the exact market price. Having discussed this, the upcoming issues for the gold bonds are the next series is coming up in February. Again, the rate at which this bond will be issued will be announced on the preceding Friday, and they will be issued to the subscribers by 9th of February. And the last gold bond tranche to be issued in this financial year 2021 will be issued in the first week of March. Just graphically, I've tried to show the trend of past issuances. So if you would take a look, obviously this is going to be mirroring how gold has moved over this period. And the first issue was in November 2015. And the next issue in January 2016 was actually at the lowest issue price for any sovereign gold bond, which was at 2,600 rupees per gram. Consequently, the highest issue price was actually in August 2020, where it was issued at a price of 5,334 rupees per gram. And if you look at the returns, so if you look at a 1-year return, the absolute returns obviously look very attractive, especially because gold has really moved quite aggressively in the last 1.5 years. But if you look at the CAGR returns, what is that we can notice the 5-year CAGR return on the sovereign gold bond, and it is just above 14%. Mind you, I have not included the return that you get via interest in these calculations. This is purely on the gold aspect to show that sovereign gold bonds actually also mirror the returns of physical gold. If we include the return that you get via interest rates here, then this will go up by another 2.5% annually, and it will actually give you about 16.5% return in a 5-year period. So this is it from my side. Thank you so much for your time, and I'll be more than happy to answer any questions later on if they're posted. Thank you.
Yeah, thank you so much, Madhav. Excellent presentation. 14% CAGR, very attractive. Over 5 years, started tempting me also. Though I don't have too much of money, but still it tempts me. 14% CAGR, and that too, as you said, it's exempted from tax. So which means a person who's in the 30% tax bracket actually gets another 30%. Okay. I think Patil, Chief Business Officer, BS Limited. I'd like to thank you, Mr. Patil, for your organization, supporting us for organizing this webinar. Allow me 1.5 minutes of reading out a bit about you. Mr. Samir Patil heads the business development of BSE Limited, including equity and equity derivatives, currency and commodity derivatives, fixed income, debt and mutual funds. He is instrumental in setting up and responsible for the business development of India INX at GIFT City IFSC. He is a board member of India Inc.'s Global Access. He has about 21 years of experience in financial sectors like commodities, currency derivatives, indices, etc. Mr. Patil was associated with MCX since inception for more than a decade as a senior vice president for precious metals and business development, and also with KJ Investors Services India Private Limited, an affiliate of the Cargill Investors Services of Illinois, Chicago at US. as a senior financial analyst. He's credited with the successful launching of the flagship contracts on gold, silver, crude oil, and copper at the MCX. His gold metal contract was awarded as the best innovative contract of the year by FOW Singapore. He's awarded the India UAE Business Ambassador of the Year 2018 at Abu Dhabi and was nominated for the prestigious IIFC Awards for excellence in respective fields. So that's Mr. Patil for you. And, Mr. Patil, I would just like to draw your comments also on today's topic with a newspaper article or the first page news which I saw in Times of India today, which was basically saying
Unfortunately, I'm not able to listen to you. You're not audible.
Can you hear me now?
Yes.
Okay. So I'm just drawing your attention to an interesting newspaper brief today in the Times of India, which was basically talking of an investment of 10,000 in the Sensex in the base year of 1979, and compared the gold with the Sensex also. So it'll be nice to hear from you since you're coming from BSE on this news part as well. Over to you.
Thank you so much. Thank you for the kind introduction. First of all, I would like to thank PHDCCI for inviting us here and be a part of this session. Shri President Shri Sanjay Agarwal ji, Shri Vivek Sehgal ji, Shri Vijay Bhushan ji, Madhav Bhushan ji, Rajiv Agarwal ji, and my dear friend Naveen Mathur. So it's indeed a pleasure to be here and speaking in front of you. In fact, when Mr. Vijay Bhushan ji spoke to me last week, and I said 21st, I'm actually occupied the entire day as my committee meetings, but nevertheless, you tell me a date and time, I'll be present on that. I'll share at least 5 minutes, but I have my colleague who will give the entire explanation about the product so that, he gives you in-depth understanding of the product. So I had to actually add a session at 5 o'clock, but it's stretched now. So I'll try to, cover up as much as possible. I'm actually getting late there. It's an international call, so I have to be there on time. But nevertheless, when the entire session started, before the session started, I heard some conversation. I just overheard a conversation about SGB, what exactly is SGB and all. So I thought I'll just read out the actual definition from the RBI website for clear understanding of an SGB. Many a times we overlook many things and we forget the basics. So I thought I'll just go through it. A sovereign gold bond. What is sovereign gold bond and who is the issuer? The sovereign gold bonds are government securities denominated in grams of gold. They are substitutes for holding physical gold. Investors have to pay the issue price in cash, and the bonds will be redeemed in cash on maturity. The bond is issued by Reserve Bank of India on behalf of the Government of India. So this is basic, and it is basically a substitute towards holding physical gold. I remember, in fact, without going into the product detail and all, I'll summarize certain things which we have been witnessed over a period of time when we had interactions with the authorities and the government. When we were called for a detailed presentation of the functioning of a gold exchange in India in 2015, where we created a white paper and spoke to Shri Shaktikanta Das, now who is the RBI governor. He was then the Secretary DEA, the Minister of Finance. And I had a detailed presentation with him and for more than an hour or so. And there we first said that there should always be a substitute for physical gold, and paper gold would be a better choice. And he set up a committee. The entire work started, and in fact there was work going on it as well. But the idea was to how to reduce import and how to keep in check the current account deficit. These were the two things. And he was glad enough. He understood that. So the SGBs were announced in November 2015. First tranche was okay. Then it came in somewhere in the month of May. And then again we were called for some explanation and some ideas why it is not clicking. and I was a part of it. And I think Mr. Das, along with all the bankers and Shri Ajay Tyagi, who is now the SEBI chairman, he was the additional secretary, and I was sitting right next to him, and we were discussing about how this could happen. And I had some scenarios created wherein gold price in India is derived with two things. One is the international gold price, second the rupee dollar. So these are the two prices which impact the price of gold in India, and these are very, very important aspects. So I had scenarios wherein gold price appreciate overseas, rupee depreciates over here. Then what would be the impact of gold price in India? And so I had 7 or 8 scenarios created, and I said, this is how it is. If gold appreciates and rupee also depreciates at the same time, you can have 50,000 rupees per gram over a period of 5 years. And fortunately, this is what happened. So I don't know. It was just a scenario which was created. And I said, if it depreciates, if it appreciates, both appreciate in 26,000 can even become 18,000. But unfortunately, it went the other way, and we saw appreciation of almost 93% when Mr. Madhav Bhushan showed us that slide on appreciation. So it is one of the best appreciations we have seen in the last 5 years, nevertheless. But what I want to stress here is, in that entire meeting, I remember when I created scenarios and I said, sir, in India, people buy gold only twice, wholeheartedly. One is Akshay Tritiya during May, and second is Dhanteras during the Diwali. And we were just approaching Diwali. So I said, sir, trust me, this is a new venture, new thing which has been launched. So let us give this some time. If you actually want to attract customers or investors to come and participate, one thing you can offer is a discount on the price, a discount on the day's price. And all of a sudden, then there was a lot of chaos in the room, because everybody started saying, how can you do this? We are already paying interest, and how can you offer a discount on the price? I said, this is only one time, and this is because of Dhanteras. If you look at the general psyche of an Indian investor, for him, what is important for him is the physical gold, the feel of the yellow metal. Paper gold will not entice him initially. It will take some time, nevertheless. But if you want to attract him, you should give him some kind of a discount. So if he has an appetite to invest 500 rupees, he'll invest 400 rupees in physical gold. At least that 100 rupees he will come and invest in the paper gold. So let us do that. And we were surprised. We were really, really surprised. I spoke about a discount of 5 rupees or 10 rupees per gram. But when the issue came, it was issued at 50 rupees discount. And that was one big positive, and that tranche gathered the maximum issuers. So this and rest everything is now, even now you see a discount in pricing. So they are continuing. But the point that I'm trying to make is, BSE somewhere or the other always sees to it that the end users, the end customers are benefited out of the entire thing. And last but not the least, the government of the RBI gives 1% interest to the exchanges, stock exchange or the receiving agents as an incentive. What BSE does is, it passes on the entire 1% interest incentive that it gets. It passes out 100% of the entire 1% to the member brokers of BSE, so that the member brokers wholeheartedly promote this and ensure that they also make they are incentivized in a very better way. So with this, I think I should sum up here. But nevertheless, when you asked me about the headline yesterday, today on the Times of India front page, Sensex against gold, last 4 decades, your 100 rupees yesterday in 40 years back would be 50,000 rupees today. So you can look at the returns that Sensex has given. So it has outperformed all asset classes. So on this, I actually would conclude over here, and I would thank you all, everybody, for giving us this opportunity today. And my colleague Ranjit Singh is there, so he'll run you through the entire product with much detail. But once again, yesterday was a very momentous day, not only for BSE, for the entire nation, because BSE clocked 50,000. The BSE Sensex saw 50,000 mark. With this, I conclude my remarks. So thank you for inviting me, and thank you for having me here. Thank you so much.
Thank you. Thank you so much, Mr. Patil. Indeed, a pleasure listening to you. And we would definitely look forward to having you back with us soon when you are not involved in your international meetings. We thank you for being here this evening. Thank you so much.
Thanks so much. Thanks.
I'd like to now request our next speaker, Mr. Ranjit Singh, the Deputy General Manager for Products and Business Development and at BSE. I'm sure he'll carry the mantle forward from where Mr. Patil has left. And I would just take a while to read out a few lines about Mr. Ranjit Singh. And as I said, he's currently working as a DTM and looks after the currency and commodities derivatives OTC debt market at BSE. Being an MBA graduate in Finance and Information Technology, that's IT, and holds a bachelor's degree in BA, which is Bachelor's of Science from the Bangalore University. He has about 19 years of experience in financial sectors like commodities and currency segment, and has experience in areas of product management, business development, financial services, risk management, broking, and exchange business. Prior to BSE, he was associated with MCX since inception for more than 11 years in product management, market operations, delivery and settlement operations, and business development. So, Mr. Ranjit Singh, requesting you to take the mantle forward from where Mr. Patil left. Over to you, please.
Thank you, Mr. Siegel, for the introduction. As we were discussing about sovereign gold bonds, what role BSE plays is we act as an aggregator where we collect the bids from the on behalf of members, and we process this and we send to RBI for the validation process. I'll run through the presentation, but I'm not getting an option where I can. Okay, I got the option now. Just a second, I'll just.
While the presentation goes up, I must share we have a lot of questions coming up in the chat box as well as the Q&A box. Mr. Singh, any problems in displaying? Please.
I'm not able to access. Please, Mr. Speaker, I'm facing some problem with accessing to my folder where I've stored. It's not giving an option to go to my folder. But someone there can run my presentation because already I've been shared with Ms. Suhali Gupta.
Okay. Okay. So, Hale, can you please display the PPT or send it across to me? Then I can quickly do that.
As you all aware that we got earlier, the sovereign gold bond was only permitted to banks, post offices, to do the aggregation for. But in 2016, after a follow-up with the government of India, Ministry of Finance, to allow exchanges also to be a part of collection of sovereign gold bond, in 2016 we got a permission from government of India as well as from RBI to act as aggregator where we collect the bids and we process it and we send the validation and we do the allotment of the sovereign gold bond is being done by the RBI, and our role is to collect the bids, share all the information which is received by the RBI, and we do the validation part also. See, if you want to do a sovereign gold bond through BSE, if you are a member of BSE, you get an access to a system called IBBS. It's called the book building system, where you can log into where you can, a lot of members, as being aware that we do IPOs, SPOs and OTP. In the same system, you can log on to the same system. There is a model called SGB model. Go to the SGB model. The second part will be, you'll get a screen called bid entry, where you enter the ECC code, where you, once you enter the ECC code, you get all the information with what is the DPID, what is the member name, client ID, and there another option is you need to select how many grams you want to subscribe on behalf of client, whether 1 gram, 2 gram. anything in multiple of 1 gram. Once your order has been placed, once you place an order, submit the order, it will go to our order book, where during the evening is the cutoff time. See, I want to tell you that our IBPS system runs 24 hours. You can bid anytime, but the process timing, we have a cutoff timing at 5 p.m. in the evening, where we collect all the bids collected from the members. We download all the bids and we send all the bids to DP for the respective DPs, either CDSL or NSDL, depend on the details, DP details, where we do the validation process and we collect lot of information with bank name, with IFSC code and everything which is required by RBI, and we download that file and we upload that same file after the process of DP. We upload into the eCubear system. eCubear system is a system which is being provided by RBI, where we upload all the DP validated bids into the eCubear system. Once all data which have been submitted by BSC is validated with the system, validated with the database which RBI is keeping in their system. Once the process has been completed, you get an information on SGB module. Also, if you go to bid entry, then there is a 2 option. One is called DP validated, which is verified or pending. Second option is RBI validation. It says pending or verified. If it is verified, that means your bid isn't successfully completed. Only thing you need to do is the payment process, that is T+2 process. That is trading plus 2 days. Suppose you bid it on Monday, your amount will be debited. So RBI validated bids money only we collect from the respective member and on the T+2 basis. And this process keeps on running from Monday to Friday till evening 5 p.m. 5 p.m. is the cutoff time on the Friday, because we have a cutoff time with RBI also. So we have to keep that cutoff time. So once details, the payment has been received on the Monday, see, sometimes what will happen is like due to some wrong entry by a member, that some data is missing which is not validated by DP and is not validated by RBI. There in bid entry book, you get in IBPS system, you get an option where you can do the necessary changes. It will come with an reason why DPS is not validated. Might be client name is missing, or joint holding is name is missing, the PAN card is not matching. Due to some reason, it will give you a reason where you need to rectify that reason and you can resubmit the bid. Once the bid has been submitted, then it will again send to RBI for validation. See, most of the problem which we come across in over the last 3-4 years, which we were doing the bidding of in RBI, most of the time the problem we come across is like wrong category. I'll tell you what is in my wrong category. Whenever a member bids and bids on behalf of his client, maybe the client has been taken a sovereign gold bond from banks also, because it is applicable from banks also. So there he might have invested a category as an investor, but when he comes to you, he says that my category as a individual or other, or you can say as a joint holder. So that problem we have come across. So whenever you take a bid from your client, my humble request is like, try to validate, tell him that if you have already bidded your sovereign gold bond, you already bought a sovereign gold bond from any other source, maybe from other exchange or from the banks also, kindly take his investor category and try to put it on. Because Friday is the most of the time when our system get lots of bid, because there's a last day of the bidding, so we get a lot of bids. So due to that, some reason, some of the bids get missed because we don't have sufficient time to process the bid also. So my request is, whenever you take information, take all the information. Then another problem is like, some of the clients may not have a account with you. You see the client account with you, but he still wants to bid from you. You can take a bid process based on his PAN number. We can enter the PAN number and DP details and can submit the same thing. Not need to have a UCC with you or need to have a DP details with you. Irrespective if he has a DP details with other member also, you can do it same. Only thing you need to enter the details of the DP details also. So another part is like on the response which we got, we also kept a module in MFD model, mutual fund distributor. Even the mutual fund distributor can bid the sovereign gold bond, which we have developed over last 3 years back, which we developed in our MFD modules also. Not necessarily you have to be a direct member of BSE. If you are just a mutual fund distributor of BSE, you can also do a sovereign gold bond bidding through BSE also. Another thing is like on the details. Whenever you enter, you might find it despite that the details which you have entered, because UCC most of the time UCC doesn't get updated. Maybe the client is not active for a long time and you don't detail. So if you take a details from your client and if you see there's a mismatch in DP, currently he was holding and now he's changed to some other DP, put the details and he can submit the process same. And we have an ID where you can, any problem you come across while you can contact me or our trading ops department where we can help you out with processing of your bid or validation of your bid or any other details you required. We are there to help you out. And I'd like to thank you here. And if anyone has doubts related to bidding process photo, I'm ready to answer them questions.
Thank you very much, for all those details which you shared with us. Unfortunately, we could not play your PPT because it's apparently a PDF format. So had it been a .ppt, maybe it would have been a lot much easier. So maybe there is a issue in displaying PDF which we had from you.
Okay. Sorry for that.
No problems at all. And we will come back to you with questions. I can see quite a few of them in the chat box, as I said, and also the Q&A section. That does bring us to the last, but definitely not the least, speaker for the evening today, Mr. Naveen Mathur, who is the Director for Commodities and Currencies at the well-known Anand Rathi Group. And I'd like to read a few lines about Mr. Mathur. He's as I said, the director at Anand Rathi Shares and Stockbrokers Limited. With rich industry experience for almost 2.5 decades in financial markets, Mr. Mathur has been associated with various organizations involved in trading equity, commodities, and currencies. Earlier, Mr. Mathur was the head of commodities at Religare Commodities Limited and Angel Commodities Broking Private Limited. He holds a prestigious CFA degree in finance and has also done his PGDFM from Institute of Management Technology, which is the IMT, Ghaziabad, if I understand it correctly. His professional accomplishments include as chairman of Commodity Participants Association of India for the Western Region, member Product Advisory Committee Indices for NCDEX, past member Risk Management Committee of Forward Market Commission, which is the FMC, and past member of SEBI, the CDAC Subgroup 1. So I present to you, ladies and gentlemen, Mr. Mathur, our speaker for the evening. Over to you, please.
Well, good evening, Vivekji, and thank you, Vijay sir, for inviting me on this particular forum to discuss and share certain perspectives of mine. And as you mentioned rightly, sir, earlier when we spoke about the topic, it's a very apt topic to discuss. I would say certain things before sharing just the 3 slides of mine, and which will give a perspective to why somebody should hold gold as part of the portfolio. I'm thankful to Rajivji also. We met so many times personally during the various conferences in SOCHM and CPAI, but glad to see you after a long time, Rajiv sir. So I'm thankful to you, thankful to the entire PhD team, including Sohail and Vivekji. Now, if you allow me to take on the 3 slides, which speaks everything. about the gold. And I think after this particular slides presentation, I don't have to say too much of the reasons why somebody should flock towards accumulating gold or investing in gold as part of the portfolio. I also would like to thank Mr. Saurabh Sanyal for inviting us to share our views. So, if you may allow, I'll share my presentation. Can you see this presentation?
Absolutely. Please go ahead.
Okay. Now, I take the cues from what Madhav said at the start of the seminar. And after that, Samir and Ranjit also presented their views in terms of why you should have gold and a portfolio diversification of gold into your portfolio. See, we all love gold. Yes, we used to love gold differently at earlier times. We used to buy gold for occasions. We used to buy gold for ceremonies, etc., etc. Of late, the charm of gold has changed just for these purposes, not restricted to just a marriage ceremony. I've got a bonus today, so where to invest? Let's go to gold. So let's buy gold. So these were certain inhibitions we saw in earlier times, and I think Vivekji, you would agree with me. I mean, in areas, in times of those sort, related to my father and my family, the elders, there was nothing much of the options which you can be investing in. And particularly therefore everybody, as Madhav rightly said, kind of a safe haven. So everybody actually accumulated gold, saying so that they are doing it, and predominantly that was the main reason of maybe the marriage of your son or the daughter, relatives, etc., etc. Now, with advent of globalization, we saw India markets opening up, and therefore you have now the whole gamut of financial products, depending upon what you want to buy, what you want to sell, what's your risk profile. Means you're an aggressive investor, you are a timid investor, you are in an age of 60. Okay, so you got a voluntary retirement or the retirement benefits after retirement. Where to invest? Means I think my father did it only in a couple of things, which were national saving schemes, which used to give double returns of 7 years, etc., etc. Or the fixed deposits. Or last but not the least, gold. Now, with globalization and with various avenues available to suit a kind of a different asset classes for different kind of an age group of investors, you tend to therefore do better. And I think beyond physical gold, the first thing which came up for investment was gold ETF. After that, yes, the BSE or the exchanges like MCX launched gold derivatives on these exchanges. And of late, in 2015, we have started seeing the new innovation of the gold sovereign bonds. Now, I won't detail too much into why and one should get into sovereign gold bonds. I think Samir, Ranjit, and Madhav have clearly spelled out the features of gold sovereign bonds, which makes an interesting kind of an asset, kind of a product to be part of an asset class, which is bullion. Now, means I'm not saying to just run on Monday and accumulate gold. I'm not saying that. It has to be a systematic, a disciplined approach to have your portfolio allocation towards gold. Now, I'm not going too much of a back times. I'm just showing kind of a stuff which we have seen in 2020 with this pandemic. And people who are part of fraternity must have seen it in 2008 and 2009. Now, let not be go to 2008 and 2009. Our memories are pretty much fresh, and we are still currently on the pandemic, maybe coming out of that. But our equity portfolios really took a toll by end of March and early April. When this pandemic, we realized, would hit the global world, the entire across world, to be kind of a pandemic and nothing to be seen, kind of once in a lifetime event. Now, with that, many of us would have thought, till that particular event didn't happen, the lure of equities, सब कुछ अच्छा चल रहा है, markets 42,000, 12,500. Why to venture out in something which is different? But then within a month, we saw kind of years low, both on the Nifty, stocks, and even Sensex too. Means we saw Sensex at around 26, 27,000. Yes, today it's a time to applaud at 50,000, but there was a crisis if you only have a portfolio related to equity or debt. Now, why portfolio diversification with equity is important, or the bonds or the fixed income products is important, I'll present in the 3 slides. But mind you, when the equity was in doldrums, real doldrums, not far away 10 months back, the gold was touching all-time highs, be it in dollar, be it in rupee. We saw an all-time high of gold in Indian markets, particularly at around 56,200 on August 7th. Now imagine, just hypothetically imagine, if you have put in your eggs in one basket and those eggs are same, I think you would be in much of a great soup. I'm not saying that the markets have returned back to more than normal, but imagine if this would not have been the position, or the markets would have not taken a V-shaped recovery, it would have been a real dent to your portfolio for how many years you have accumulated that particular portfolio. Saying so, it is therefore very important to diversify and don't put your eggs in one basket. And gold plays that critical role to be having a low correlation with stocks, and it's a study. Just 0.19 of a correlation with stocks and hardly any correlation with bonds. Now, somebody may question that bonds are the fixed income sources, and 2 or 3 of the speakers have said that this is also a safe haven. Gold also is a safe haven. So I'm thinking safe haven as fixed deposit or bonds, where I'll get decent returns, little better than whatever the bank gives me. and why you are saying that the gold being a safe haven has, I would say, no correlation. Now, bonds are dependent on yields, and stocks are dependent on certainty or uncertainty. Now, the kind of an uncertainty we saw in last 9 or 10 months, there has never been this kind of an uncertainty. The world economy, be it the Wall Street or the real street or the main street, everybody just stopped. The whole economy of the world were at standstill together. Now, this was a great uncertainty. We haven't seen it maybe in our lifetimes. So that kind of an uncertainty actually led the people to get into the safe haven asset classes. And I think the real estate, which we feel where we are living is a safe haven, did not pose even an iota of the characteristics which these particular commodities, and particularly gold, actually play out. So from around 30 sub-thousand levels for 10 grams in India, the gold went up into the straight line to an extent of 56,000, which it touched in August. So one part is stock that in an uncertain environment, we saw the stocks going down and the gold going up. And similarly for the bonds, which are dependent on yields, if the interest rates goes down, inverse correlation with gold, or the dollar depreciates, the gold gains. Although it's still March 2009, but you see kind of 1970 to 2009, just a pictorial representation. Now, we all remember that as the other speakers too put out, that in spite of whatever role it plays, it also plays a very critical role in terms of hedging the inflationary risks and during the inflationary periods. Now, say for example, if you are seeing 72 to 74 December, the inflation in the US actually climbed to approximately 3 to 11%. And therefore, if high inflation, the commodity performance cumulative in that particular 2 years or 2.5 years was mind-boggling to an extent of 200% plus. The next inflation, where we all know the Fed came out and it did that many things in the US, the inflation figures touched to an extent of 14% in 4 or 4.5 years, from 5%. And we are seeing the performance of commodity, which is approximately 90% plus. And similarly, the case of 86 to 90. And these are studies. These are real studies which lets us know that just saying is not enough, but the number speaks, or the graph speaks for itself. Now, from 2% to 6% of inflation when the crude touched an all-time high of $147 in July 2008, you saw the inflationary tendencies moving from 2% to 6%. And from that particular time, it was plus 54% kind of returns from the commodity. Now, one way to see it, that yes, crude is part of the commodity. Now, the crude prices definitely are going from X to Y on the upside. The inflation bound to go up because the crude is part of the driver of the economy. So whatever activities you do, your margins would cut down to a little or to a large level of what the crude actually is posing a threat for. So means what I'm trying to say means basis this, we can see the annualized kind of returns for the period of 74 December and July 2007 to July 2008, what kind of a performance on an annualized basis the commodities have given. Now, this is just my last slide, and this is the study which has been done sometime back by Chicago Mercantile Exchange, part of now the NYMEX or the CBOT. Now, if you see, I know that people will not be able to understand it just by seeing it, but I would draw your attention to the far right of this particular table or block. The far right, this area. The traditional portfolio. Now, the traditional portfolio used to be 55% stocks and bonds only. I don't want to get my money be invested into anything else. I know bonds, I know fixed income, I know FDs, and I know stocks, Reliance. I know that I have invested in blue chips. These would be the best of the stocks and best of the fixed income products. So 55% kind of a traditional portfolio to stocks and 45% for fixed income gives me the I would say standard deviation on the horizontal line or the risk on the horizontal line of the bottom dot at 9.6% plus of the risk and around 14% kind of returns. Now, with diversification talks moving out, so from my elders, my fathers to myself, the kind of an age difference, I think I'm fine with taking some kind of a risk. And therefore, the 10% of the managed futures now in US, the managed futures are commodity derivatives or the commodity futures. So that means I am adding 10% to my stocks and bonds. You can see the risk at around sub 9%, and my returns also have become better at around 14.5%. Now, the best of the portfolio is this, the 1, 2, 3 number, wherein I have the 45% stocks, 35% bonds, and 20% managed futures. Now, you can see the least risk on the horizontal and the highest return on the vertical. Now, going further, if you do, sometimes the economies of scale also not work. Maybe you will have the higher returns, but you are an aggressive investor, you will have to bear the higher risk also. So what I'm trying to give you a perspective through these 2 or 3 slides was something that if somebody really wants, you should be, people keep saying 10 to 15% of your portfolio, but this is what is the reality, that a part of the commodities and particularly the gold in your portfolio makes sense from the studies and the real-time understanding what we have seen in the last 1 year or so. So I think I would recommend everybody, you go anyway, whatever suits you of the products, be it a sovereign gold bond or ETF, but still it makes sense to make a corpus which has 15% of gold into the portfolio. So with that particular note, I end my discussion. I think I have taken a lot more time, but then I felt that it has to be said very clearly, and this is what it is. So I would request everybody to see this portfolio diversification, not just for the sake of having a theoretical understanding, but we have witnessed in last 9 months, and these theories prove right, which is inverse correlation to risk assets, which is gold and equity and bonds. So thank you very much, Vivekji, for inviting me, and I end my thoughts on this slide. Thank you very much.
Thank you. Thank you very much, Mr. Mathur. Indeed, a pleasure listening to you with all the knowledge flowing across, which you shared with us with your more than 2.5 decades of experience. And I really like your point on, it's not like Monday morning, please go ahead and buy. Let's look at a more systematic and a planned approach. With that, it came into my mind the SIPs which you do, wherein you actually keep committing yourself though, but you could probably plan a more systematic and a planned approach towards the gold bonds as well. So you wanted to say something?
Yeah, I was just adding a line to that particular thought of yours, sir. Means I don't invest in equity in spite of 2.5 decades spent in these markets. I don't get into a secondary market directly. I invest through mutual funds, which is kind of good stuff for having an exposure on equity and debt. And I'm personally was doing the investments through ETF on gold. And I exited in August. I started in 2008 and I exited on August, fortunately the same day when the gold hit an all-time high. So it makes sense. It really makes sense in terms of discipline approach towards any of the financial market products, but needs discipline. So thank you.
Thank you. There are a lot of questions. Let me ask a very quick one if you can answer that. You talked about portfolio being diversified also into gold bonds, etc. So let's say looking at an aggressive investor or a timid investor, what part or what percentage of portfolio should it vary from for an aggressive investor to a timid investor?
It depends. Means I can become an investor from timid to aggressive if I see the markets, what they have done to my portfolio in the last 10 months. Means people would feel that ये तो सबसे अच्छा है, घर में लैपटॉप के ऊपर ट्रेडिंग करो, पैसा बनाओ. The people have seen the kind of phenomenal returns in the last couple of months, not years. So that is something which is very critical for any investor, I would say, to understand. आज 800 पॉइंट गिरा, कल 500 पॉइंट गिरा, तो वो jokes भी हैं. मतलब कि this is not just a one-side rally that you have seen it from 25,000, 26,000. In less than a year, we are at about 50,000. So as they say, means the Rome is not built in a day. Means therefore the portfolio can never be seen as such just by looking what you have done in 9 months. So it is going to continue for 90 years or 19 years.
Right.
I think a disciplined approach should start from day one. Means day one when you start earning. So I think the aggressive or the timid, by virtue of the definition, is very fluid today. Means the kind of returns we see, a kind of a timid investor becomes a trader or a aggressive investor, because the money or the greed of money, and the money lures money. So therefore, even if you wanted to be part of HDFC Bank in April, or say XYZ, you have seen phenomenal returns. So now your greed starts questioning yourself कि 9 महीने में 9 लाख तो क्यों और ज़्यादा नहीं? So I think 15 to 20% is for kind of an aggressive, but at least minimum of 10%, it must be part of the portfolio and disciplined way. You do SIPs on the ETF, you buy sovereign gold bonds. That product definition is something which is very particular for an individual, but I think 10% to 15% should be good to manage kind of risks which we have seen in the last year.
Thank you for giving me the answer. 10 to 20% between timid to aggressive. Let me see if Madhav agrees with that.
I would not entirely agree. I feel if somebody is very aggressive and has the time, so there's two things. One is your risk tolerance and your risk appetite. So one is how much risk can you afford to take, and the second is how much risk are you willing to take. So if somebody can afford to take a lot of risk and then is willing to take a lot of risk, they can have a lower exposure to gold, in my opinion. But yes, I feel a minimum of 5% is required because it adds diversification to your portfolio. So it considerably brings down the standard deviation, or how we put it, as the risk in your portfolio. 5% is something most people do, and which is not very common for a lot of investors my age. So a lot of young investors do not consider gold a sound investment, and I think it's time to slowly change that and educate people of the benefits of having gold in your portfolio.
Right. Wanted to hear a young mind also, because I'm sure a lot of people who would have locked in would be also looking at looking at what youngsters have to say, because probably they're able to see details in a lot of things. With that, I think I must go on to questions first in the chat box, which I have. With the permission of the chair, I don't think the president is with us. I think he must have moved out for some other programs and other engagements. With the permission of the chair, shall we start the Q&A, Mr. Bhuchan?
Yes, I think let's go, but let us keep a time of 6:30 to close. So
Sure.
Yeah.
Yes, I think the topic has evinced more interest than what we envisaged. So I'll request the panelists to be as brief as possible in their answers. The first question is, since the current price of gold is very high, how would we benefit from redemption? So who would like to take it?
No, I'll answer that.
Please.
Actually, the price has come down from 5,600 per gram of gold, as Naveen mentioned. So actually, this price is already down, and it's consolidating at at a 5,000 rupee per gram level. So I think with a 10% the fall, I feel this is a good time to buy gold. Naveen, if you'd like to add something.
Sure, Vijay, so whatever you are saying goes pretty much right. I want to be short, Vivek sir. I'm apologizing for being a little elaborative on my presentation, so therefore the question answer session. I think there is no timing, please. There is no timing as a start today, even if you want to buy gold. Do it with discipline. Yes, as far as the view is concerned, we are coming out of the uncertainty largely. So Brexit is done, US elections are done, Trump has flown back to Florida, and the pandemic vaccines are doing wonders. So So with the uncertainty going down, coming out of that particular stuff, that 56 has come to around 49 today. Now, yes, there is too much of a liquidity, and with that liquidity, the inflation would start picking up sometime. And against a hedge again, and people would flock to buy gold, but be a disciplined investor. I don't see gold touching beyond 52, 53 on an immediate basis. Currently, yes, as Vijay sir rightly said, we are consolidating at around 50,000 here, 1,000 there. So I don't see too much of a bull run as of now, but yes, it's kind of a neutral to little slightly bullish in terms of medium terms.
So I don't know whether it's right to say viruses do good to gold.
That's right format, sir. Let's be out of this. We come to a normal life.
Right. Next question I'd like, in case Mr. Ranjit Singh would like to take, when we buy SGBs from secondary markets, suppose I bought 2070 in SGB, having an expiry in 2025. So after I purchase, the expiry remains the same, or will it be counted from my purchase date?
No. Any bond which comes, it always comes with the expiry date. The expiry doesn't change once you buy from secondary, you buy from primary. The expiry date remains same.
Okay, right. So thank you for that clarification. Then I have a question which says, when the Government of India issues these sovereign gold bonds, where is the underlying gold found in the statements of accounts of Government of India? So, Mr. Ranjit Singh, would you like to take that?
So there is no such statement which has been come out by RBI where it says that this much gold is being kept for sovereign gold bond or any other thing. It's RBI. Sorry, we don't have any details on that part. RBI is not disclosing that part.
I would just like to add, so the Government of India reported, I think, a gold reserve of slightly over 600 tons of gold. And till date, all issuances of sovereign gold bonds combined have accounted for close to 31 tons of gold. So you can be rest that in terms of the government's gold reserves, they are well covered by due liquidity for your gold bonds. It's only the gold bonds will aggregate to over 600 tons of gold. In a situation where we need to worry about, the government not being able to service their sovereign gold bonds.
Okay. Thanks, Madhav, for pitching in and giving that answer. Now, I have another question which says, can we take rebate of buying sovereign gold bond in tax? If yes, will it be covered with the limit of 1.5 lakh as per Section 80C, or would it be over and above that? Taxation expert presentation, Madhav, back to you.
Purchases of sovereign gold bonds will not be considered under Section 80C. So that will be over and above. However, again, if you hold the bond till maturity, the gains are exempt from capital gains, but the investment amount cannot be counted towards Section 80C, that 1.5 lakh. So that would lie outside the purview of Section 80C.
Okay. Thank you so much. This question I don't really quite understand. It is from a gentleman called Mohit. May I request our co-chair to kindly attempt to understand and answer this question. This client having depository in NSDL cannot have in DMAT form. What does that mean? I haven't understood that question. Do you want me to repeat it?
Yeah.
It says client having depository in NSDL
Yeah.
cannot have in DMAT form. It just says this much.
I think he's trying to ask, tell us he have in demat form or not? I think so. Vijayji can.
I think you are right. There are two ways of it. Firstly, can you have it in demat form if he has NSDL? Yes, he can. The other thing could be, because this was a problem earlier which has now been solved, that in case he buys from the market and he has an account with NSDL and the delivery comes in CDSL. Earlier there was a problem because then he had to open an account with CDSL also.
Yeah.
Now that facility has been made whereby even if the delivery comes in CDSL, he will be able to get it in NSDL. So I think either way, it's no longer a problem.
Yeah.
Okay. I think a very pertinent question. Being a paper gold, how far one can trust government that it will be able to pay it? Why not we think that it will not be Triffin paradox effect?
Well, I don't know what is Triffin paradox, frankly. But what I can say is, as already stated, the government gold reserves are adequate to cover. It's only if the total issuances are more than 600 tons. We are only about 5% of that. And while we don't know, the government can always hedge. As you know that in markets abroad, you can also hedge for with a 3-year future. So I think the governments may decide to hedge in case they feel that the gold price is really going up. So I think, and really speaking, if you don't trust the government in India, all the currency that you're holding, that is worthless. So as they say, a sovereign instrument bears the lowest risk. And of course, if the sovereign is to fail, then we all have had it.
I just add a line to what Vijay sir said. It's interesting to note that the central banks too invest in gold. So what we are talking about, gold reserves itself, the central banks also invest in gold. Now, secondly, the question of government, why SGB, is for a simple reason that the government does not want to import physical gold and create a ballooning fiscal deficit, which will hurt our pocket sometime or the other. So what they are doing is, instead of 23,000 tons of gold lying in our households, trusts, mandir, which is means they are monetizing somehow, or they want to monetize this particular demand by virtue of doing SGBs. So you are out of physical, you are gaining at 2.5%, but underlying still remains a sovereign gold bond. So I think it's a very good thing, rather than thinking about government do bhi to gold bhi dubega or SGB bhi dubega. Rather than thinking about, we should think about that how we can benefit as an underlying through SGB. So that's my call.
Well said, Naveen. Well said.
Absolutely wonderful. Just a question which may sound a little academic. Does the issue of gold bonds anything to do with the physical gold which the government holds?
I really don't think so. I think it's basically they are covered by the gold, so they so that is there. Just to give, because I think there is a worry. Let me tell you that after the 1962 war, the government that time, again there was a foreign exchange problem, and they asked for if people could give gold, and those bonds were issued, and they returned gold for gold. And I remember in the initial part of my career that we had bought gold bonds, and then those gold bonds RBI gave physical gold. Similarly, in when Manmohan Singh became he was the finance minister, again we had gold bonds where after a period of 5 years gold for gold was given, and it had a very low rate of interest. So I think if past is any guide, then I don't think there should be any worry that the government will not be able to honor its commitment. I think we are well within that, and government is doing that because they know the kind of appetite there is there for gold. As Naveen correctly said, rather than that leading to a fiscal imbalance of that being imported either directly or as you know, there's been also always this issue of smuggling of gold. So it's better that paper gold is there so that this appetite for gold can be fulfilled and people can get that same appreciation without physically having the gold.
Plus 2.5% more than
that's
what
the
annual returns are.
That's the sweetener.
And at the same time, Vijay sir, it is also beneficial that you don't import and physical रखना कि मैं कितना खरीदूंगा और कितना कहाँ पे रखूंगा.
Correct.
So it's a great monetization tool to satisfy your demand of 900 tons every year, which you used to import, but at the same time benefiting from the characteristics of what you were looking for.
Great. Because I'm not a CAD expert, but I think, if I'm not mistaken, Indian imports of gold top the list of imports in the country.
After crude, sir. After oil.
Okay.
After
oil also, no.
So 75% on our demand is being done by imports. So the oil is the largest import to the exchequer. But in 2015, we were the second or the third highest in terms of our appetite for gold.
Right. So great and a wonderful session. We've been we had the pleasure of our Secretary General also listening to us and spending time with us, Mr. Saurabh Sanyal. Because we cannot thank the speakers enough, and for all the information and the knowledge they have shared, we have requested our co-chair, Mr. Rajiv Agarwal, co-chair of our Capital and Commodity Markets Committee at PhD Chamber, to express a kind vote of thanks to all the wonderful sharing of knowledge on this platform today evening. Mr. Agarwal.
Thank you, and very good evening to all. On behalf of PHDCCI, respected leadership team, eminent panelists, and dear participants, it's a privilege to be such in a esteemed company. I'm honored to give a vote of thanks on behalf of PHDCCI. We are extremely grateful for your presence and really appreciate that you all were able to take time out of your busy schedule and participate in this webinar. I will especially like to thank our panelists for sharing their insights with us on webinar on sovereign gold bond. Mr. Samil Patil, Chief Business Officer, BSE, my dear friend, Mr. Naveen Mathur, Director Commodities and Currency, Anand Rathi Group, Mr. Ranjit Singh, Deputy General Manager, Products and Business Development, Bombay Stock Exchange, Mr. Madhav Bharat Bhushan, Co-founder and Vice President, Indian Youth Economic Association. I would like to thank Mr. Vivek Ji, Assistant General Secretary, PHDCCI, and Secretariat team for organizing this event. I would also like to thank BSC for our sponsorship for this webinar and delegates for their valuable participation. As already discussed by our panelists, I would like to emphasize that sovereign gold bond provides a better investment avenue for investors to make it as a part of their portfolio. The best part of sovereign gold bond is that it provides an assurance of safety, zero risk of handling physical gold, offer assured interest along with price rise benefit. That is more important, and easy exit option. I would also take opportunity to thank our Honorable President, Mr. Sanjay Agrawal ji, for his encouragement and support, which made us to this event possible. Once again, thanks all. Thank you for all. Thanks.
Thank you, Rajiv Ji, for this great honor. 1 minute बचा है, 6:30.
Yes, I
would like to thank Mr. Saurabh Sanyal for having joined us. Thank you, sir.
I was extremely busy with many other activities because we can come only 3 days now. We are coming on a roster system. So there were so many activities which were left today. So I'm really, really sorry for joining late. But the fantastic presentation which was made by Madhav ji and all the other esteemed Mr. Mathur ji, the intervention which he did and the points which he brought out, and other speakers who are there, including Mr. Agarwal and you, I mean, it was fantastic. My only query was that whether it is only the sovereign gold bonds where we must go in, as I was discussing with you for a very brief moment. There in my office, or we must also doing very well in the state government bonds. Many of them are doing extremely well, and they're giving a an interest rate of 12%, 11.5%, 10.5%, and some of them on they are easily redeemable. They can be sold in the stock market and bought from the stock market. And so even after that, you get a 6 monthly or a quarterly interest, as well as you can sell it at a higher rate, depending on, or at the same rate, and still you redeem about 9.5 to almost 8.5 to 9%. I mean, even that is an excellent idea of, and the government is giving a lot of, stress on improving the sovereign bond markets also, which has a lock-in period of 5 years, and after that you can, it is actually for 7 years as in the sovereign gold, but thereafter you can again, reinvest or sell it off in the bond market. So bond market is also one of the things which is coming up, sir. I just, a few comments if you can give us. Because I am at that stage where I am doing a lot of investment of my hard-earned money, which I earned in my government service and which I earned later in my second tenure.
Sir, I would think we should look at the state government, something which is guaranteed by any state government loans or bonds guaranteed by the central government. Definitely we can go through. In the state governments, there is a wide variation because many states very large deficits, and while I think the principle is safe, I'm not so sure. On the interest angle. However, I think what you said is pertinent. We also have been talking of, and also some of the from secondary market picking up certain state government papers which are being quoted. So definitely there is a market there, and yet one has to be careful because what RBI has done with Yes Bank and Lakshmi Vilas Bank, the bonds issued by them, which they have written down to zero, I think we need to be careful.
But RBI, what about RBI sovereign bonds?
RBI bonds, no problem.
So are they better than in parking your funds in the banks, or what would you suggest? What is your recommendation?
They are better, but of course they are now, I think the tenure is 8 years. So you are locked in for 8 years.
No, if a person does not need the funds immediately, will it be prudent or will it be advisable to go in for these sovereign bonds of the RBI and other state governments, or rather than going in for an FD in banks? Because FD interest rates are absolutely at the bottom today. They have taxed absolutely.
So the RBI bonds, which they market through the banks, which is currently the tenure, the rate of interest is 7.15, and which is reset based. It is normally 0.35% over and above the national national savings certificate over the NSE rates. That I think is a good instrument to take, because the safety, from a safety angle, it's very safe, and today is offering a higher rate than the banks which have come down, to
5%.
5%.
And thank you, sir. It was a pleasure listening to all of you. I'm really, really honored. We are all honored, and I hope the participants who have been attached with our program, they must have also benefited a lot. I personally benefited a lot.
Thank you, sir.
A lot of doubts have been cleared with Mr. Madhav's presentation. Thank you. Thank you so much.
Thanks a lot, sir.
And thank you, Vivek, for putting this, for organizing this and getting all the experts and stalwarts together. Thank you.
Sir, just a second, Saurabh, sir. Interest rates are going to go up, maybe not in near future. So RBI, therefore, the bonds are above the NSE rate. So you will always benefit better than whatever NSE rates are. I think they are 35 basis points more than.
Right.
So
thank you.
Something which is also added up in due course of time.
Thank you. Thank you, sir. Thank you.
Thanks a lot, sir.
Thank you, SG. Thank you, speakers. Thank you, chair and co-chair. And my special thanks goes out to my colleague, Ms. Sohail Gupta, who's been working day and night to put this thing together. Sohail, yes, kindly come on camera. Thank you very much on behalf of all the speakers and all the chair and co-chair.
Thank you so much, sir.
Thank you, Vijay sir. Thank you, Vivek ji and Rajiv ji. Sohail, heartiest thanks.
Thank you.
Thank you.
Thank you.
Thank you.
Thank you.